welcome to episode 54 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric Johns.
And I'm Rachel John.
Let's dive in.
Sorry.
Glad you sounded ready. That's awesome. That's a great start. Let's go.
I was trying to anonymize the names of our scenario people.
Okay.
Today.
All right. What you got for us? Did you finish? Did you get there?
I think I came up with what we're going to use. But
Okay.
Don't make fun of me. Okay.
If this is Harry Potter, come on, man. You're going to go Ron and Hermione now? That's what we got?
No.
Okay. Well.
I wrote Shrek and Fiona.
Okay.
But I like yours better.
No, we're good.
Can I change it?
You can change it. Oh, man.
Sorry. Hermione's my favorite person ever, so
Yep.
I need you to know. But I think I'm going to be sad if our scenario doesn't make her seem really sad. Okay. So we have really had so much fun talking about all of our various scenarios. And so this is yet again another scenario. This was one that was written in through the podcast portal. So hopefully if you guys have one that you're interested in having us weigh in on, you let us know.
Yeah, please do.
Again, there may be information here that was missing or that we don't have. So please do not take this as financial advice.
None of this is financial advice. Right. Just back of the envelope, ballpark hypothetical.
Yeah, just public discussion of certain scenarios.
Absolutely.
Okay, so
let's go.
Ron and Hermione.
Questions first, right? This scenario?
Yes.
Got
it. But Ron and Hermione are 58 and 56.
Okay.
And they have one adult child, age 25.
Got it.
Okay. No special situation that is causing that one to be a dependent.
Got it.
So they are not yet retired, but they are certainly trying to plan for retirement on the earlier side.
Okay.
So the questions that they had for us were, how should we adjust our investment portfolio as we approach early retirement?
Okay.
What strategies should we be employing to help us pay off the credit card debt before retirement? How can we ensure that our savings and investments would support a comfortable retirement lifestyle?
We want to retire early.
Yes.
And we have to pay off a ton of credit card debt.
It's not
typically in the same sentence.
It's not a ton.
Okay. All right.
It's not a ton.
All right. Proceed.
But
we'll get there. That's interesting.
Yes. It's not a ton.
Especially from Hermione Granger, Rachel.
I know.
Okay,
and we might need to go back to Shrek and Fiona.
Proceed.
We're going to blame Ron on. Ron would definitely do that.
That's true.
He bought all the chocolate frogs.
That's true. All right, well, let's do.
So then, how can we ensure that our savings and investments will support a comfortable retirement style, right?
Okay.
So that was that.
Portfolio, credit card, investments.
Correct. So are you ready?
Fact set. Let's go.
Again, they are 58 and 56.
Yep. 25-year-old child, you said.
Okay, 25-year-old child, yes. They have $60,000 in their savings right now.
Okay.
They have $7,000 in checking.
Got it.
Okay. Then in their investments, they've got $400,000 in a 401k or in the 401ks.
Okay, combined. Got
combined,
it.
Yes. $50,000 in IRAs.
Okay.
And they have
Roth or traditional?
Traditional.
Okay.
And $30,000 in a brokerage account.
No Roth.
No Roth.
And 30 in a brokerage, you said?
$30K.
Okay.
Yeah.
Okay. What is their income and expenses? Do we know?
Their annual income is $130,000.
Okay.
And they state that their expenses are $90,000.
Got it. Maybe.
We will see.
Probably not. But go on.
They do have a house that is worth $350,000. It does have a current mortgage.
Got it.
Of $100,000 with a 4% interest rate. So they haven't been super eager about paying that off.
Got it.
And they also have a car.
Mm-hmm.
They have $15,000 in credit card debt.
Okay.
And that is at 18%.
All right.
Okay.
Okay. Ready?
Then they did say their retirement goals, because I did ask,
what
are retirement goals? Their retirement goals are to retire comfortably in 5 years.
5 years.
with an annual income or something to support $80,000, annual income of
So they think
$80,000.
they're going to decrease their spending by 10K if their spending is 90. Got
So
it.
that was my first thing I paid attention to as well, is that they believe that they will be spending less in retirement,
Yep.
not more.
Usually want to make people approve that.
Yes. We would, and honestly, prove it to the point of we have granularly looked at your spending habits. Categorically, this is where it's coming from. So what are you cutting to get to that 80? Like, where are we reducing that? Because
Mhm.
it's fine and dandy to say I spent
Yeah.
90, now I'm going to spend 80 less. $10,000 less where? Are you
Right.
stopping
No,
dining out altogether?
that's a really good
Like,
point because people hear like, oh, you're only going to spend 80% of what you currently spend in retirement. So
yeah,
let's just use those numbers. Like, not necessarily why you might spend more. You're going to take trips, right? Like people want to retire, they
your
want to go
trips fill your
tour
day
Europe.
in a
Yeah, they want
different way.
international travel. Those kinds of things are very common.
Correct.
You're going to be bored, like you said, fill your day. Like, I mean, if I'm here all day, like I'm going to eat sushi, like maybe participate in some hobbies that might cost some
Yeah,
dollars. Like,
probably build a new computer,
you're absolutely right.
a few new computers.
That's a very good point. And gaming's actually a relatively cheap or inexpensive
I
hobby.
was
You
going to
only
say
have to
that is a
spend your
cheaper one.
$2,000 on your computer. You're all set.
But yeah, exactly. I mean, you may even be looking to join various social groups
It
to
might go up rather
ensure.
than down. So,
Correct.
and we're not even sure the 90 is the actual spend. So yeah, the just
Something to be wary about.
first thing, right off the bat, out of the gate, they have $60,000 in what's being termed a savings account. And recently, we've seen quite a bit of this. We've seen people say, "I have my money in a savings account,"
Yep.
and so they're thinking that must mean that I'm getting the federal funds rate, right? Like I
5%.
should get
Yeah.
5.25 right now until they lower it next month. But right now they're thinking that they're getting like 5%
Right.
ballpark, maybe 4% plus.
Which is probably why they're not, like, if you have that much sitting in your savings account, but you think it's generating more than the interest rate on your mortgage, you're not very incentivized to start paying down that
No,
mortgage,
but
right?
you should be incentivized to know that the difference between 18 and even 4 is significant,
It's 14.
and you should pay the credit card debt with the $60,000 you have sitting in a savings account.
I will
I
say,
can't think of too many reasons not to do that. Like you could probably come up with some fringe scenarios, but there aren't too many unless unless some bookies are after you and there's other unsubstantiated debt or whatever. I don't know, but really unlikely that there's any better use of that 60,000 than writing a $15,000 check to your credit card company currently.
and I don't know, and there was no elaboration on that point or anything like that, but I know that, like, psychologically there are sometimes certain barriers to writing a check that large if your expenses are usually just frequent smaller expenses. So maybe the reason you're not paying it off is because you're like, ooh, if I have 15, then my 60 goes down to 45, and so that may feel like a huge portion of what's there. But if you look at the percentage that you're paying in interest for nothing,
Right.
that adds up so fast.
Right. So that's the lowest hanging fruit, right?
Correct.
That's a no-brainer. You definitely do that. We would probably have a very candid conversation about early retirement here if they're trying to generate even $90,000
Yeah.
from their portfolio for any number of years, right? We would say if you're going to retire early, maybe you want like a 3.5% withdrawal rate. If you're looking at, if you're looking at a 3% withdrawal rate generating $90,000 a year, or even 3.5. Let's give them 3.5. We still need $2.5 million.
Yeah, it's
Right?
large.
We don't have $2.5 million,
Exactly.
and we're unlikely to in 5 years.
Exactly. And that's the issue, is that, like, you'll have Social Security eventually.
Yeah, total we're at like maybe 500K.
Correct. But you're
So,
not going to have, I mean, our younger spouse, like, they wanted to retire together.
yeah,
And that's still not out of the question. It just may not happen in 5 years.
right.
But our younger participant, right, is Hermione, is 56. Right.
Yeah.
So in 5 years, you're 61. You're still a long ways off
Right.
from.
And you'll get some help from Social Security along the way, but typically we want to defer Social Security at least for the higher earning spouse until 70, right?
Right.
So even with Social Security coming down the road, what?
Again,
What?
that
A pig?
happiness.
Let's do it up. Shall we? Haha, got it.
Thanks to Zoe's number one dad.
Yeah, it's pretty sweet.
Yeah, pen holder.
Right. So let's go back to their questions though
Okay.
before just absolutely throwing a wet blanket on their dreams.
necessarily what blanket. It's not saying that they cannot happen, but it's saying that if you want them to happen in this way, like these
There are
are
going to
the
be some
things that need to.
significant trade-offs, right? You're going to be
Mhm.
spending half as much as you're planning on spending.
The thing is that like we've certainly worked with people or even conversed with people, and it's much easier to say you're going to do something than to do it, and we wouldn't be
Yes.
working
Boy, is
in.
that true.
Exactly. So we're not working in the best interest of our clients if we just hear them say, "Yep, I'll cut back and I'll spend
Right.
75." We're like, "Cool." And we make
Send
a
it.
exactly, if we make a whole plan based on that, then we're not doing anybody any favors.
Right.
So it may be like, let's keep your plan where it's at while asking you to spend less, and then let's come back
Yeah, see if it
in
works. See if you
2 or
can.
3 months and see how stable that's been.
Right.
Because oftentimes we'll come back. It's really easy to say, "Oh, it was December. I had to get Christmas presents. Oh, that was my niece's birthday."
Hmm.
Like those things aren't going away. So those are things that have to be factored into that annual budget anyway.
Right. So
Okay.
speaking a little bit to their questions, though,
Yes.
right?
So the first question was, how should we adjust our investment portfolio as we approach early retirement? Now it's interesting because
They
in
might not be
said,
approaching earlier
well, true, but in said investment portfolio, they didn't specify
where it
how they
is
were
today.
invested.
Right.
So we don't know what percentage stocks, bonds they're in.
Or
We
what?
do know that there's no tax-free buckets, right? So
Right.
there's
There's
no
no
Roth,
Roth. Yes.
but we have 400,000 in 401ks, right? 50 in IRAs,
Hmm.
30 in brokerage. So we
Yep.
have about half a billion in
Billion. Half a billion would
half
be.
a million.
Oh, I
I was
thought you said
swallowed.
billion.
So no, not half a
Wow,
billion.
that would be pretty
Half a
sweet.
million there ready to
They
go.
could definitely send it.
You have about half a million in your like investment vehicles that we're looking at there, right? So how do you adjust the portfolio? It's hard to really weigh in on that when we don't know what the portfolio would be.
It is, but just generally speaking, I just would say that we're not. I think that the kind of conventional wisdom is maybe a bit overstated when we talk about shifts towards fixed income in
Mhm.
retirement, right? So I think purchasing power risk is understated, and market risk is also understated from the bond side, but maybe even overstated from the equity side. So what I mean by that is conventional wisdom might say that if I'm 80/20, I need to go to 20/80. I need to take this radical shift where I
Yeah.
used to have 80%
In
stocks
stocks.
or equities, and now I'm going to go all the way down to 20.
Yeah.
It's in our view, in my view specifically, it's a little bit more sensible to not go that far, and continue to provide yourself some hedge against things like inflation,
Hmm.
purchasing power reduction over time with bond funds, right? Like we've said this many times, if you buy a fixed income instrument and it's $100 today, and then I get the principal back, I go and spend those coupons. It pays me
Correct.
$5 a year, and I spend it. Spend my $5 a year, and
Hmm.
then I get my $100 back 5, 10 years from now. My $100 when I get it is not worth what it is today.
Correct.
So I'm eroding my purchasing power over time, and I don't really have a plan to replace it in a lot of instances, right? So we typically would depend on the equity side of our portfolio to try to keep up with inflation a bit more, and therefore we might not want to reduce it as much as conventionally told to do so. That's not to say never get under a thing. Like, there's no
Yeah.
broad rule of thumb. And so for some individuals, it might make a ton of sense to go all the way down to 20% equity.
But also
But I'm saying that, like, that's just marginally overstated. That's all I'm saying.
that, but in this situation, it could be that we're looking at a situation where they're currently invested incredibly conservatively.
Sure. And then we might need to
And
open it up a little bit.
their
Yeah.
risk capacity, like the
Great
risk,
word.
thank you.
Great
But
term.
the risk they need to take in order to meet the goal of retiring early
Yeah.
is pretty significant. They are far off of that $2.5 million mark.
Very
So
true.
that's not to say that if you change your investments with the 500,000 that you have, that you'll like bam get to 0.5. But
So when is your CFP coursework
they
starting?
are.
Oh, come on. This is exciting.
Oh Lord.
Everyone should be excited. This is
Yeah.
great. Rachel's
No.
in the game.
But
Let's go.
I'm saying that like there are scenarios, there are viable scenarios where your investments may get um closer to a stock bond percentage split rather than moving heavier towards the bonds. Um
Can we talk
and
about coursework a little bit? Can I? How hard can I push to derail this whole episode
absolutely
and
not.
talk about Rachel pursuing
I'm just studying
designations?
with you. That was work.
Yeah, but you're smarter than me. You'll kill it.
Yes. I will gladly get a different
All
designation.
right. Okay. Okay.
You don't need two of us.
I'm kidding.
There's
All
only
right.
one of you.
I'm not kidding.
One of you's a
I'm
little.
not at all kidding. She's good at it. Um,
So okay, how to adjust your investment. It'll really depend upon how you're currently invested,
right,
how you're comfortable investing,
right.
and what
Globally
income will you
diversified
live in.
portfolio
Yeah.
based on your risk tolerance, right? Like there's going to be some percentage in stocks and bonds. Location's going to matter. We want our bonds held in 401k. There's not a ton in the brokerage anyway, so it's not unlikely to be held there. Our brokerage account, frankly, is mostly going to be an emergency fund, overage, or capital savings, I would expect. They're going to
Mhm.
need new cars, things like that. They only have 60K in savings. We'd probably move that to the brokerage
Well,
to take advantage of money market.
they're about to have
That's
45.
correct. 45 because they're going to pay off the credit card
Yeah,
debt. So we're going to take the 45, move it to the brokerage. Now we have
correct.
75 in the brokerage, probably going into a money market with most of that, if not
Yeah,
all of it.
exactly. Because like we said, they didn't even specify that it's in a high yield savings account,
Yeah.
which again, but
I assume if people don't, or if it's just like a Chase savings account or a Capital One savings account, almost certainly it's not high yield, and almost certainly you're getting paid almost nothing,
like
right? You're getting paid pennies on the dollar. Like
pieces of
it's going to be
pennies.
yeah, it's
It's not
exactly
even
that's
pennies.
a very good
It's
point. It's not pennies on
literally,
the dollar.
it's
It's literally
not.
fractions.
It's
It's like
not.
0.04%, I think was the last savings account we looked at.
Exactly. It's pennies on the like
It's never
thousands
good.
of dollars.
Nobody wait, I've never seen a yield on a
It's
savings account and be like, wow, that's great.
let's all put our money in that
Yeah,
savings account. Yeah,
never true.
no, never been tempted.
Right.
So the second thing was what strategies can help us pay off the credit card debt before retirement. Now,
Write a check.
exactly. Now the thing is, I think
Form an ACH or write a check.
it's so hard because typically
That's why we went to school. That's why we have the letters behind our
make
name
them
to tell
right.
you to write a check.
Oh Lord. But honestly, sometimes that's exactly what
I
they need is
agree.
to
Yeah, it's a
know
simple answer.
writing a $15,000 check, which can
Is
feel huge,
objectively correct.
is what you need to do.
Absolutely the right
And
call.
I will say, I think that, we talked about this. Not all debt is created equal, although all credit card debt does
Is
seem to fall
pretty
into the worst category.
yeah, it's bad.
But the extent to which you have credit card debt matters greatly. $15,000 in credit card debt, based upon what national averages look at, is actually relatively small.
It's tame, but there's just no
It's
reason for it.
exactly. While it's small, paying 15 or 18% on any amount is
It's
ridiculous. It's
nonsense.
an egregious
Right.
rate. Um, so you're in a position where you could pay $15,000 right now, do it. Now, if we're talking 200,000 in credit card debt, then we're looking at
Now we got some bigger problems.
yeah, but we're gonna have to come up with a way to
Yeah, we gotta have a plan there.
yeah, for sure. It's gonna be factored into the budget that
Yeah, you
we
probably have
have.
if you have that much, you'd have
So yeah,
30
strategy. There's no strategy needed, and I think a lot of times, like strategies to pay off debt, like that's one of those buzz key phrases that you'll see on all the blogs and
Yep.
all the
Gets
whatever.
people clicking.
Correct.
Everybody
And
has debt.
if you are, if you've got 2,000 saved up and you have 15,000 in credit card debt, then you certainly need a strategy.
Right.
There's only
No,
one
we're
option.
they're all good there. That's not a real
Yeah.
concern in my mind.
And then finally, how can we ensure our savings and investments would support a comfortable retirement lifestyle? And to be clear, this is where they specified that while they pay 90 or spend 90,000 annually, in their minds,
They want to spend 80.
a comfortable
Is 80.
exactly is 80.
Right.
So again,
We got to start with their cash flow, make sure that it's
right,
even 90. And
right.
then we need to talk through how they're getting to 80. There
Where are
needs
you
to be
cutting that 10?
yeah, they need to be they need to convince themselves and us that or and their planners or whoever's helping them
Correct.
that they're actually going
And
to go
that's
to
what's
80.
hard. I will say when we do a cash flow analysis, we really like to get really personally tailored to the people that we're working with and break up categories into what's relevant to the client.
Mhm.
And I'm going through the Rolodex of categories we use in my mind, and like arguably they might spend less in gas because they're not traveling back and forth to work.
Right, but
But
that's
how are
like
you
one of the lowest
spending
categories every month for everybody.
exactly? Dining out, I cannot imagine
That's
goes
not going
down,
down. There's no way.
right? You're not bringing your like ham sandwich to
I
work.
guess theoretically you could eat at home, but
You still need to. That's presuming that you want to cook. Like I love cooking. We eat at home, but then like if you're eating at home, that's less leftovers. If
I
if
still
you're a
don't think
leftover
I agree.
family,
I still don't think you're probably using dining out more as like an experience as an outing. So like I think it's pretty unlikely that goes down. I mean, shopping, like dining
correct?
out, shopping, and entertainment are like the
Yes.
big three, right?
Well,
Those are
and
typically where
exactly.
the
And we
outliers
were
are.
actually talking to a retiree the other day who was telling us that some of the like conventional wisdom and things that have been shared with her are things like make sure you leave your house every day, make sure that you're socializing with people like every 2 days.
Those are
Just
good
things
tips,
amazing.
by the way.
I think they're amazing. I really think we honestly need to do an episode about
That's a
that.
good call.
But things that can stop you, because we've talked about this in previous episodes, that once that retirement slump hits, if you don't have a plan for what you want your retirement to look like, it can be kind of depressing.
Right.
There
You
can be
need
a whole host of
Yeah, one another way to put it that frequently people say is you need to retire to something, not
yes.
from something, right? So you don't just retire because you don't like work. You want to retire because you do like, I don't know, rock climbing or mountain biking, or well, mountain biking is probably a little much if you're
Or
65. But like the idea, yeah.
you might like fishing.
I
You
like
might
the
have a hobby.
sushi is
Sorry, I
a
love sushi.
calling.
It really is.
I'm retiring to sushi. I only eat. I'm gonna
Okay,
go
okay.
live in Japan and eat sushi every week.
Okay, but
I
how
would.
cool would
That
that
actually
be?
would be awesome, to
But
be
it
honest.
also, it might be like,
I'm in for that, by the way. What are we doing that year in Japan? Is
yes,
that like we're gonna put that on our bucket
sure.
list?
No,
All
but the
right.
thing is, like, when we live in the general New Orleans area, right? So food is a huge part of the
Oh yeah.
culture. So you may be immersing yourself in going to various restaurants,
Hmm.
right? Or it might be music, whatever it is. The
Right.
idea is that in order to indulge in some of the activities that you weren't able to do previously when you
Yeah.
worked 9 to 5 or whatever it was, those things usually cost.
Right. And the idea is you want to have these concepts of what you're going to do before
Right.
you're doing it,
So we
or you
can
get into that.
quantify them.
Yeah, before you fall into the habit of yelling at your TV for 6 hours a day,
Oh,
right?
well, how do you come back from that?
I don't know.
How do
Don't
you
think you do.
Oh, no. But exactly, and so in going through some of these categories that we're used to, um, we've seen, especially if you've got kids, right? Like, they have a 25-year-old child who potentially might have grandkids later on, but
Right.
they may wanna be spending more time with their this is pen number 3, by the way, in this episode.
I'm worse at twirling than I usually am. I don't know.
I think it's because 'cause you're happy.
Sorry. Yeah. It
So
was a good talk.
but I really do think that with the possibility of grandkids or engaging in quality of life things with their child, with their son, then you're likely spending money in those areas
I
that
agree. I
aren't
think there's more risk to
categories.
the upside than the downside.
Yeah, I do too.
Well, there's no risk to the downside,
Um,
but
but yeah, I mean, again, if they're dead set on, I know we can spend 80, then I would show us.
yeah, yeah.
Just because, again,
Let's just talk through it. Yeah.
and it wouldn't be in any kind of like accusatory
No,
tone
no, 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 no,
whatsoever.
no, no.
But
For the burden of proof.
But if we're not pushing back on an assumption like that,
Yeah,
then
we
we're
could
not
find
doing
ourselves
our
in a
jobs.
terrible situation,
Yeah,
right?
we're not doing our jobs.
Right.
So again, we would definitely want to get a firm grasp on the 90,000 now,
Hmm.
figure out why we think 80,000.
Yep.
And then, like they said, how to ensure their savings and investments would support a comfortable lifestyle. Let's say that we've looked at their cash flow. We've realized, okay, like you're spending 95 now.
Hmm.
Let's give a $15,000 cushion. So we
Okay.
think you're going to spend 110 in retirement.
Yeah.
Um, then we can start nailing down like what that kind of withdrawal rate looks like, knowing that that's what we're trying to support annually, what you really need.
Withdrawal rate. You really are getting
Oh
it.
my God. So I'm not, but it's true. But then they would need even more than the 2.5 million we discussed,
Yes.
because 2.5 million was based on the 90,000
90
now.
spend at a 3.5% withdrawal rate, I think.
Right.
Yeah.
So,
Closer to 3 if they're at 3%.
so how can they ensure their savings and investments will support a comfortable retirement lifestyle? We can tell you how many years it could do it for, and then when you will run out.
Right. They're just essentially the answer is you're just not able to retire and maintain that lifestyle until, you've run the numbers
Mhm.
and and you're comfortable with the risk that you're taking by doing so.
Correct. And by retiring early, again, and we discussed this in the previous episode as well, there's a significant runway before you're really pulling that like Social Security.
Right.
So
So your
having
subject
them,
is I don't we're going over time, but you're subjecting yourself to sequence of return risk, which is very real. And that is the tendency or the uh, uh, negative impact of having to withdraw significant portions, particularly from the equity side of your portfolio when markets are down.
yeah,
Right? So if your returns are down initially, and that's when you have to pull a ton out, now I have significantly fewer shares that can, appreciate to their market
we
value that
want
they
you
had today.
withdrawing from your stocks when you want and not when you need.
Right. You would rather the market go up and then down later when you have Social Security to partially offset your distribution needs. And now we're not pulling quite as much in terms of shares from the portfolio,
Yeah,
right? So that's what people are talking about when they talk about sequence of returns risk.
correct. Thank you.
You want to recap for us?
Okay. I didn't take the notes.
Oh,
The notes that I do have,
tragic.
I had that step number 1, pay down the $15,000 credit card
Okay.
immediately from the 60K savings.
Yes.
Have a very candid conversation regarding early retirement.
Yeah, and whether it's an
Really,
option, sure.
exactly.
How
Drill
viable is it?
down on numbers to know exactly where things are. Look at the investment accounts to see where they're actually invested. And based upon the knowledge that we had, we would really advocate a globally diversified investments based upon what their risk profile is.
Right.
So we'd have to, like we said, we'd have to sit down and really nail down what that is, and
Yep.
then see how far off from their risk profile their current investments are in the first place.
Right.
They may not be.
That's perfect. All righty. Well, thanks guys for listening. If you enjoyed today's episode, please review the show. And if you have any topics you'd like discussed or financial problems you would like solved, reach out to us at podcast@equilibriumfb.com or visit our website at
No!
equilibriumfb.com.
Oh,
Thanks, guys.
till next time.